we believe that we are one of the best opportunities right here, right now, with the potential for interest rates to rise or stay where they are, but nonetheless, we are a great opportunity because if they do rise, we've experienced that before. From June 2004 to June 2006, the Federal Reserve raised interest rates an uninterrupted 19 times, where they took the Fed funds rate from 1% to 5.25%. In that period of time, our managed income portfolio still returned a net return of close to 10%. And so we navigated those increasing interest rates back then very, very well. As a matter of fact, increasing interest rates at times can actually be good for one of the asset classes that we participate in, that being domestic high-yield bonds. And the reason they could be good for domestic high-yield bonds is that typically increasing interest rates is indicative of more confidence in the economy going forward. And if the economy is going to be better going forward, there would be less defaults in the high-yield bond space, therefore making high-yield bonds more attractive. We would be invested at times in large cap domestic, mid cap domestic, small cap domestic. And then of course, we would also potentially at times be invested in big blue chip, what you would call developed international markets, such as Japan, Europe, Australia, Canada, as well as we would potentially be invested in emerging markets internationally. So we're a global tactical asset allocator in the equity space. Tactical asset allocator is how we focus our strategies, and tactical asset allocation means that we don't build portfolios and buy and hold them. Instead, we make, at times, very severe moves in the portfolio, but of course always designed to protect the client's portfolio, as well as designed to get the client invested in the best performing asset classes at that particular time. Tactical asset allocation, as opposed to buy and hold, participates in those asset classes and at times exits them completely. So it tactically exits the asset classes that buy and hold would otherwise remain invested in. Investments at Hanlon Investment Management, our managed income allocation, which has exhibited very, very conservative attributes for the 15 years that we've been managing that portfolio, is an awesome choice to give clients exposure to a conservative side of the portfolio, but also give clients opportunity to hopefully do much better than the 1.8% they're getting out of 10-year treasuries. As a tactical asset allocator, our primary research is focused on the trends in the market. And so on a daily basis, our research team is examining those trends and determining, are we in a positive trend, are we in a sideways market, or are we perhaps in a decline and heading much lower? Our science, our research, likes to identify those positive moments in domestic and international equities, as well as in domestic fixed income, primarily high-yield corporate bonds. And when we see those positive trends, we are a buyer. And when those positive trends continue, we would continue to hold. And even if the trends flattened out some, we would typically remain invested. It's when the trends roll over that we'd be a seller. And so our research is really focused on the trends. We're an intermediate term trend follower. That's our primary science. I started as an advisor. I've been in the industry 32 years. I go back to 1983. And in the mid to late 90s, I realized that my clients needed better protection of their portfolios against downside risk. We have about 140 employees, and we manage approximately $3.5 billion for almost 30,000 accounts. I measure myself in a number of ways. First of all, did I give all that I had that day to the cause being to help clients avoid very large drawdowns in their portfolios, help clients have lower risk and lower volatility in their portfolios, and then of course help clients achieve their goals by generating good returns. All investors have goals. That's part of the role of their advisors, is to help the investor determine what their goals are. And then, of course, with their advisor, they should be able to determine what their investment portfolio makeup is that is best suited to meet their goals. And it's always important to be monitoring the progress of your portfolios against your goals, short term and, of course, long term.